So to introduce Dale really quickly, Dale Johnson conducts workshops and seminars on farm management and business planning, financial analysis and planning, and computer applications for farmers, lenders, educators, and others. He consults individual farmers on business plannings and financial management. His research focuses on crop and livestock enterprise analysis, farm machinery economics, and futures marketing. He's also active in international extension work. So, welcome, Dale.
Hi, glad to be here. So, go ahead and finish it up. I'll give you a couple minutes to finish it up. Not the back side, just the front side. What's this?
Just a little bell mic.
Okay, all right. You knew they were all false?
I thought the first one was great.
The four free pieces of the financial puzzle are solvency, profitability, liquidity, and efficiency instead of equity. Balance sheet lists the assets, liabilities, and resulting profit. No, what is it? Assets, liabilities, and what? What? Assets, liabilities, and?
Income?
No, not income. Good guess. Come on. Assets, liabilities, and net worth, equity. Equity or net worth, okay. Your owner's equity or net worth cannot be less than 0. That's false. What do we call it? We call it bankruptcy. Okay, we call it, yes. You can have more debt than you have. There's a lot of people that have more. All of my students at the university have more debt than they have assets. It's called student loans. Money received from a loan can be considered a form of income and must be included in the income statement. Oh, heavens forbid that we should be taxed on the money we borrow. And the next one is just principal payments are expenses, but interest payments are not expenses. No, the interest is the expense. The principal payments are not expenses. So the loans are not income. Principal payments are not expenses. Depreciation is included in both the income statement and the cash flow. Yes, the income statement. No, not cash flow. Cash flow is cash flow. Depreciation, you don't write out a check for it. The cash flow budget shows the exact information as the income statement, but is broken down by quarter or month. Yes, it's broken down by quarter or month, but it also shows some different things too. A positive cash flow indicates your business is profitable. No, positive cash flow indicates you have a positive cash flow. You can have a positive cash flow and lose money, or you can make good money and not have a positive cash flow. Profitability and liquidity indicate how efficient you are. Actually, a little bit, but not exactly. I am confident in my ability to be the chief financial officer of my business. You know, we have this pyramid structure in business nowadays. Most businesses are big businesses. Hundreds of people, thousands of people, sometimes hundreds of thousands of people in a business. Okay, and it always amazes me how these businesses really work. You know, a big car company, an airline, for considering how complex they are, they work pretty good. But up at the top, you have the CEO or the president of the organization, and they look at the long-term outlook of the business. Under them, you have vice presidents, directors of divisions, upper-level management. Then you have lower-level management. You have the people down here, pyramid shape. Everybody does what they do best. But outside this pyramid is the chief financial officer and the accounting department. They're outside of the pyramid because they give help to everybody in the pyramid. Director of marketing says, "What's my marketing budget?" The accounting department gives them the marketing budget. Okay. Production can say, "How much does it cost us per unit?" And the accounting department can give them that information. Oftentimes, the chief financial officer becomes the CEO because the chief financial officer knows more about the business than anybody else. And they become the CEO sometimes. Now, in a small business, you need to be both the chief executive officer and the chief financial officer in your small business, or even in your personal life. You are the chief executive officer of your life. You also need to be the chief executive officer, or you need to also be the chief financial officer of your finances. You need to understand your finances, your personal finances, or the finances of your business. So that's what we're going to talk about tonight. We're going to talk about understanding your finances. These principles can be applied to your business, or they can be applied to your personal life. They can be applied to any business. Okay? And I use the analogy of a puzzle. It's very much like a puzzle. Trying to put these pieces together of your finances. Sometimes it's difficult. But there are certain pieces of this puzzle, and if you don't have all the pieces, you don't have a complete picture. And these pieces need to fit together. And those pieces are solvency, profitability, liquidity, and efficiency. Okay? Solvency looks at the long-term financial condition of your business or your personal finances. And to measure that, we look at the balance sheet. You can do a balance sheet for your business, or you can do a balance sheet for your personal finances. The income statement. Will the condition improve? Is your long-term financial condition going to improve? Income statement is how much money are we going to make this year? Profitability. Cash flow simply looks at money flowing through your personal checkbook, your savings account, your checking account, or your business, how much money is flowing through your business. You have as much flowing in your business as is flowing out. You got more flowing out than you have flowing in, you got a cash flow problem. And then per unit analysis, this is efficiency. And especially, I'm looking at a farm here. How much does it cost per acre to grow hay? Sometimes per bale, per acre, per bushel, per animal, per hundredweight. We're looking at how much it costs us on a unit basis. And this is particular for businesses, okay? This is the productivity of resources. So we're going to look at these 4 pieces of the puzzle tonight. And I am sorry I don't have a horse example tonight. I had horse examples from many years ago and I couldn't find them. So I'm sorry, tonight you're going to look at a dairy farm, okay? And but I'll be able to understand it. I want you to keep in mind that you apply this to your business, or you can apply most of these concepts to your personal finances. First thing we're going to look at is the solvency of your business, and we look at that through the balance sheet. All right, balance sheet. Sometimes we call it a net worth statement. Sometimes people call it the financial statement of the business. Show me your financial statement of the business. Well, I consider all of these documents financial statements. So I never like that term. I like net worth statement or balance sheet. And every one of these financial statements has a bottom line. We always talk, what's the bottom line? Especially in finances. Each one of these documents that we're going to look at tonight has a bottom line. The bottom line of the balance sheet is, as we talked about earlier, owner's equity or net worth. What is your owner's equity or what is your net worth? Everyone in this room has a net worth. And I suspect almost everybody in this room has a positive net worth. And that's good. I suspect there's a couple of people in this room that have a really big net worth. And I suspect there's people in here that the net worth is growing. Okay. Now the example here is we calculate the bottom line by taking assets or what we own, not income. Okay. It's what we own, things, land, buildings, animals, bank accounts, equipment. Subtract out what we owe, debt, liabilities. And that's owner's equity. And the example here is I got land, buildings, machinery, some animals, and the value of it is $2.5 million. And then I got a mortgage on the farm. Maybe I got an equipment loan or an animal loan, $600,000. So I subtract my debt from my assets, my liabilities from my assets, and my owner's equity is $1.9 million. Okay, that's another way to look at that is how wealthy this person is. Wealth. How wealthy are you? Okay, this person is $1.9 million wealthy. Any questions so far? We call it the balance sheet because We balance assets against liabilities and net worth. They always balance. Why? Because you get the residual. You're subtracting this from this to get this. So you get the residual, okay? And the other important thing is that the balance sheet only is accurate for the day that it is done. It's only accurate for one day, okay? And so it is a snapshot in time of your personal finances or your business. And oftentimes, I encourage people to do a balance sheet at least once a year, okay? And January 1st is a good time. Now, I don't suggest you do balance sheets on January 1st. You're probably in no condition to do balance sheets on January 1st. But you can do a balance sheet for January 1st. You can do it on January 15th. But you can go back and say, okay, on January 1st, what are my finances like? I encourage you to do a balance sheet every year for your business or for your personal life. And you look at all your assets, you look at all your liabilities, and you say, okay, what is my net worth this year? How wealthy am I this year? What is my equity this year? And it's going to change on January 2nd or February 1st. But you know what it is that one day, and you can compare them year after year. And hopefully your net worth is growing almost every year. Some years it'll grow faster, some years it'll grow slower. But hopefully it's growing every year. Because as your net worth grows, you're in stronger financial condition. You have more flexibility to do things you want with your business or your personal life. As you're going through your life, if your net worth is growing, you're going to have an easier retirement, or it's going to make it easier to pass on the business to the next generation. Wealth is convenient. It's convenient to have wealth. Some people say money can't buy happiness. And there's some truth to that. But poverty is miserable. And some of you know that. I know that. A lot of us know that because we started out in poverty, and I'm glad I started out in poverty. Okay, with my wife and I, when we were going to school, I'm glad we started out in poverty because it makes us appreciate what we have, and it makes us frugal, and it makes us manage our finances. So poverty is useful when you're young, but as you get older, you would like to have something, and you'd like that something to grow every year. Okay, so I said that assets minus liabilities equals net worth. So the balance is we're just changing the mathematical formula. All right, so we're going to give you an example of a balance sheet. This is an organic dairy farm example. I work with dairy farms all the time. So this was a convenient example for me to show you today. And this is actually an example from an actual farmer, although I've changed numbers, even the farmer wouldn't know it, okay? Because I've changed numbers for illustrative effects. But it is close to what at least one organic dairy farm could do. Now, I showed you the format of the balance sheet. Assets on the left-hand side, liabilities and net worth on the right-hand side. Now, if you're going to print this out of QuickBooks or Quicken or other accounting program, they're going to have assets, then they're going to have liabilities, and then at the bottom, net worth. They don't have the side-by-side. This is just for illustration purposes, okay? But the first thing here is, up in the right-hand corner, date. You've got to put a date on your balance sheet because it's important, because it's a snapshot in time. All right, what is the date for this balance sheet? Then we have assets. On the left-hand side, what we own. And most balance sheets in the world are divided up into current and non-current. Two categories, current and non-current, or sometimes current and fixed assets, okay? Now, in agriculture, we insert this intermediate, okay? And I'll explain that in just a minute. Let's look at the current. Current is things that you can easily convert to cash. Bank accounts, obviously. And then on farms, prepaid expenses and supplies, stuff sitting out in the shop, fertilizer ready to put into the ground, seed ready to put in the ground. Accounts receivable. An account receivable is money that somebody owes me. And I'm going to probably collect it in the next few days or weeks. Okay, so that's money I'm going to get. That's a current asset. For example, this is a dairy farm. That $11,000 would probably be the milk check that hasn't come in the mail yet, or hasn't been deposited in the bank account yet. All right, so that's an account receivable from Organic Valley or Horizon or whatever. We got things that can be easily turned into cash, or things that are usually turned into cash during the production cycle. So I'm going to feed, in this case, feed dairy cows, grass, concentrate minerals. Okay, this is stuff that I'm going to turn into milk. So they're current assets. I'm going to turn that hay and concentrates and minerals into milk, and that's what that's worth out there. So then I have my total current assets. Okay, any questions about current assets? Intermediate assets is particular to agriculture. And in agriculture, it is breeding livestock and equipment. And the reason we do that in agriculture is because breeding livestock and equipment are usually a big deal. We have a lot of it. We have a lot of equipment on farms. And in a dairy farm, or a horse farm, or other type of animal production, the breeding livestock is an important part of the business. And so we want to analyze it separately. So, I mean, you could go out and sell the horses easily, or you could sell the cows easily, but we don't do that. They're there for production. Okay, so we put them under intermediate in agriculture. Now, market livestock, animals that we plan to sell, they would go up under current assets if it's animals that we plan to sell. Okay, so here, this is a dairy farm, cows, heifers, machinery and equipment. And of course, I will probably have a schedule attached to this that lists every piece of equipment and what the current value is of it. And I would probably have, I'd have it from my records, a record of every cow, and I would have an average value on those cows to come up with those figures. All right, so that's our intermediate assets. Any questions? Yes?
Why wouldn't you put machinery and equipment up in the regular assets?
In the current assets? Because current assets are for things that are cash or that we plan on turning into cash during our production period. Okay? Yes, we could easily sell equipment too, but we're not going to. We don't want to. So that's why we keep it here. And then long-term assets, the farm, the property, the house. And in this case, 200 acres, $9,500 an acre. So we have our total assets. What's that?
We're talking about land rich, cash poor early, and then just balance it.
Yes.
Demonstrate that.
And some places in Maryland, that's low.
Yeah.
I mean, I'm flabbergasted at some prices on land nowadays.
20,000 acres.
Yeah, I'm flabbergasted at prices of land nowadays. And that raises the question of how do you put values on some of this stuff? Okay, now, yes, go ahead.
The intermediate farm assets again, because I never looked at this kind of balance sheet. Is that intermediate a specified time frame? Is that a year? I mean,
It's equipment and breeding livestock. No, yeah, okay, if I was to tell my student, the question is there a time on it?
okay.
Usually I will tell my students stuff that lasts between 1 year and 10 years. But even I don't think that's a good description. I just say machinery and breeding livestock. There might be a few other things in there, but that's basically it. Okay. So the question is, how do you get these values? Now, if you go to an accountant, they'll tell you, well, the values are on the books. It's for what you paid for it minus depreciation. What you paid for it minus depreciation. Okay, for example, a tractor. You paid $100,000 for the tractor, and then you've depreciated out 75%. It's worth $25,000 on the books. Okay, or what did you pay for the piece of land? Well, right there you can see there's a problem. Okay, and even accountants realize this, and so accountants sometimes do not use that. Okay, if you put the value of that land that you bought it for 20 years ago, you know that it's worth 3 times that much now. So to find out what your real net worth is over here, you want to do a market value balance sheet, which makes it difficult. How much is that equipment worth? Well, you can go through and ballpark it, each piece of equipment. A lot of dairy farmers know what cows are going for now. So these are estimates. These are estimates. And on this $2.5 million, you know, it's probably accurate within a couple of $100,000. And that's good enough, okay? If this is accurate within $200,000, it's probably good enough. So we are just estimating these things, okay? Now, any other questions about assets? I'm actually moving pretty slow here because I got a lot to get through tonight. Liabilities, current liabilities, debts you got to pay off this year. Credit card, feed bill. Okay. There's a category I don't have in there.
Taxes?
If you owe the taxes. Now, if you owe taxes, if you're going to pay your taxes in July, you're not going to put those on here because this is January and you don't owe them yet. If they're from last July and you haven't paid them, then you're going to put them on there as a liability. Yes. Okay. There's one other line item here. The current or the debt payment on intermediate and long-term debt that you're going to pay this year. Okay, got a mortgage down here. How much am I going to pay? How much principal do I have to pay down on it this year? That goes up here. But then it gets subtracted out of here. You don't count it twice. Okay, so if I have $560,000, if I'm going to pay down $20,000 on the principal this year, $20,000 goes up here, and this is $540,000. Okay, same with equipment. The current portion goes up here. All right, so this is the debt. There's no interest here unless you owe the interest. If you owe the interest on January 1st, it goes in here with the principal. But if it's just interest you paid, no, it doesn't go on here. All right, so intermediate loans would be loans on equipment and breeding livestock. Okay, and then long-term liabilities, a farm mortgage. Usually we say 1 to 10 years, and usually we say over 10 years. However, what if you only have 8 years left on the mortgage? It still goes down here because it started there, and we don't move it. Okay, so total assets, $2.5 million. Total debt, $600,000. Net worth, $1.9 million. Okay. Debt asset ratio. I don't really have time to talk about some of these. I'm not going to talk about this. Debt asset ratio is a ratio that we often look at. Is we divide your total debt divided by your total assets. 0.24 of my assets are obligated to somebody else. Okay, the mortgage and the equipment loan and the okay. You kind of look at, I own 75% of my business and somebody else owns 25% of the business. That's another way to look at it. All right, so if you haven't done a balance sheet in a while, I encourage you to do a balance sheet for your business or for your personal life. You know, personal life, your home, retirement account, automobiles if they're worth something. There's been times in my life my automobiles aren't worth much. Anything of value, and sometimes how much is your house worth? Well, you're not going to go out and get it appraised, but you kind of know what houses are going. Sometimes we overestimate the value of our houses. Okay, don't overestimate things, but don't underestimate things either. So, do an estimate of what your assets are worth, and you can actually get your debts down to the penny. You can through statements from your bank and other places, you know exactly how much you owe, and find out what your net worth is. I encourage you to do that this coming week. Do a balance sheet for yourself. Find out how wealthy you are, and some of you will be pleased. Some of you will say, okay, this is all right. Some of you say, well, I wish it was better. Well, it's a starting point then. You have your balance sheet. Next year it will be better. Any questions about the balance sheet? Next, profitability, or an income statement. Now, this is the only statement required by the government for small businesses. For small businesses, this is the only statement required by the government. All right? If you have a business, you're going to file a Schedule F for a farm or a Schedule C for a small business. You can even file a Schedule C for a farm if you want. I've seen that done. Okay? But the government wants this. Why? They're going to tax you on it. They're going to tax you on this. Okay? Now, other business forms, sometimes they want the balance sheet too. Okay? But, the income statement, this is pretty familiar to everybody. This is profit. Sometimes we call it the profit and loss statement. And everything has a bottom line. And the bottom line is profit or loss. I should have put or loss in there. Profit or loss, because businesses lose money. And it's not unusual for business to lose money once in a while. And the example here, income. And income, by income, we mean sales or revenues, or maybe I need to even make it more clear. Money you get from the business, from conducting business. I got to be more specific. From selling product or services, not from selling an old tractor or a piece of lot on the front of the road, frontage road, okay? No, that is not revenue, because you don't normally do that. This is from product and services you produce, okay? An example, $300,000, cash expenses. This is any inputs required to generate the sales or revenues. Okay, $165,000. And then depreciation, all right? It requires equipment to generate sales and revenues. I go out and buy a tractor this year, $100,000. Well, the $100,000 is not an expense, because that tractor is going to last longer a year. We only take a portion of the tractor, the depreciation. We depreciate that tractor over several years. We only take part of the value of the tractor of the cost. So depreciation is the cost of buildings and equipment. If I buy breeding livestock, and I'm going to keep the breeding livestock for a few years, I'm going to depreciate the breeding livestock. Okay? And so, income, $300,000, expenses, $200,000, profit is about $100,000. All right, so let's look at an example here. Oh, no, let's look. Here's Schedule F for farms. And Part 1, farm income. Part 2, they call it farm expenses, okay, operating expenses. And line 14, depreciation, okay. And the bottom line, net farm profit or loss. And then I saw Schedule C floating around, and it's got, it's very similar to Schedule F, except it's for another business. It doesn't have agricultural categories. Okay, so let's look at a organic dairy farm. And I actually have 3 income statements for this organic dairy farm, 2019, 2020, 2021. 3 income statements. And let's look at the average of these 3 income statements. And I'll show you how we calculated it. First of all, those lines over there, the number on those lines match Schedule F. Okay, so this actually came from Schedule F. And QuickBooks or Quicken, when you set up the categories right in QuickBooks and Quicken, we'll generate it. Generate it for TurboTax or H&R Block Tax software. Okay, once you set up your accounting system, it's not difficult to do. Sometimes it's difficult to figure out where an expense goes because sometimes it's not clear. And sometimes it doesn't matter. You know, you put the expenses where they seem to fit best, and that's probably good enough. All right, let's look at the average of the 3 years. This farm had an average of 80 cows. This is an organic dairy farm. They sold 9,200 hundredweight of milk per cow. 9,200 weight of milk per cow, or 9,200 pounds of milk per cow. Now, if you know anything about dairy, you know that that's really low. Dairy cows now are producing 20 to 30,000 pounds of milk per year. But that's normal for an organic dairy farm because these organic dairy farms have their cows out on grass. And some of them is not just organic. They're really, I mean, a lot of these people are dedicated to this idea, and and some of them get extra premium for grass milk. Okay, not just organic milk, but grass milk. So their cows are out on grass all the time. Hay does count as grass. Okay, and so their production goes down quite a bit when it's just grass that they're being fed. But then, of course, their price of their milk from Organic Valley for grass organic milk is much higher. Total hundredweight of milk sold, there's the price per hundredweight, $36 per hundredweight, compared to normal prices, which are down in the high teens, low 20s per hundredweight. So they're getting $15 more per hundredweight than conventional milk. All right, so we multiply those together and we have our milk sales, a little bit of crop sales, not much. Cattle sales, organic dairy farms, their cows tend to last more lactations than conventional. It's not unusual for their cows to go through 6 or 7 lactations compared to 2 to 4 lactations, which means they have more breeding livestock to sell, heifers. Because if your cows last longer, you don't have to turn them over as much. So you got heifers to sell. So cattle sales on an organic dairy farm are actually important because they're selling organic breeding stock, and there's a higher demand for that. So that's important. And of course, that's calves too, bull calves. Most of them are not putting sex semen in them. They're getting, taking whatever, and so they get the bull calves, and those bull calves are not worth much. Okay, and then there's always other income, custom hire. I go out and do some baling for somebody else, or and sometimes there are some subsidies from the government. Dairies have had some subsidies in the last few years. So then we add up all of our income, $303,000. And then our expenses and custom hire, we're hiring somebody else to do some field work for us, so of some kind. Depreciation, that comes from a schedule where we put our equipment, our breeding livestock, and the IRS kind of tells us how much to depreciate. How much should you depreciate your equipment each year? And there's a schedule. And of course, if you're in QuickBooks or Quicken, that's all, and you set it up correctly, that's automatic, that depreciation is automatically generated. And then we have feed, fertilizer, and all of the other expenses. Okay. And feed is usually machinery is, and buildings is oftentimes the biggest expense, but feed comes right in there too. Feed expense is big on a dairy farm. And repairs and maintenance, that's another big one here. And so we have about $200,000 in expenses, and they're making about $100,000 a year. Here, we're comparing it to 7 organic farms the average of 7 organic farms that I do the records on. And this farm is above the average of the $76,000 that the average organic dairy farm is making of this group. And that is higher than conventional dairy farms. And even that doesn't seem very high. It's not very high. That's why we only have, when I started my career, there were over 2,000 dairy farms in Maryland. And I thought, I'm going to help the dairy farmers. Well, apparently I didn't. Because there's only 300 left. Okay. About 300 left. So, and that's why, because there's not a lot of money in dairy farming nowadays. Any questions about an income statement? All right. Personal finances. What is your income? It is your salary, any extra money you make. Okay. And, or if you're retired, Social Security and other things, what is your income? And then what are your expenses? I encourage everybody to do budgets. How much money do you bring in each month? How much money goes out each month? All right. You're living within your means. All right.
How often should you do an income statement? I mean, you said once a year at least. For
farms, for businesses, once a year.
Really? Just once a year?
Yeah. Because, all right, let me give you this example here. Dairy farm, an income statement in the spring, let's say it's a conventional dairy farm. Income statement in the spring doesn't make a whole lot of sense because you've got a lot of money going out for seed fertilizer, chemicals, and other things. And so it's really skewed in the springtime. And then in the fall, when crops start coming in and you're selling crops and things like that. So on many farms, it's very skewed through the year.
So you
now,
have a year where you think you're going to get the best snapshot, not just where all the money's going out or all the money's going in.
you're going to have to do it usually it's a calendar year for almost every farm, every agricultural entity. It can be a fiscal year, but almost in agriculture, it's usually the calendar year. So you're doing the income statement in January, February, usually March or April, you're doing the income statement. Okay, now I will say horse operations. I used to do more with horses than I do now. And for horse operations, it might not be a bad idea to do income statements monthly. You're looking at boarding, training, all the different sources of income. And it is a little somewhat constant through the year. So it might be useful to do it on a monthly basis.
Well, can't you do budget and actuals too? I mean, you could do both at the same time.
Yes, you could do budgeting and actual at the same time, yeah. Mm-hmm. Okay, efficiency per unit analysis. And sometimes this doesn't apply. It might not apply to some farms, but it applies to a lot of farms. And this is where you're looking at, how much does it cost you to produce 100 weight of milk or calves, beef calves that you're going to sell? How much does it cost you to produce those? Or in a horse operation, you're looking at your training versus your boarding. What is the boarding? How much money are you making on boarding? How much are you making on training? And you say, where are my money-making enterprises in this business? And which enterprises I'm making the most at? That's where you're trying to take that income statement and spread it out between your money-making enterprises. Because you're trying to see which enterprise is good and which is bad. Or which is not so good. Which are my best enterprises, and maybe which ones I need to focus some more on, okay? So enterprise, efficiency is about profit centers. It's about enterprises. And here, the first thing we're going to look at in this dairy farm is per cow. We're going to take that income statement and we're going to put it on a per cow basis. Now, I like per cow basis because my farm can only support so many cows. It's kind of a limit. My farm, there's a limiting factor. I can only support so many cows. So how much am I making per cow? And I can compare that to other farms on a per cow basis to see how efficient my cows are compared to their cows. Right? I can also do it on a per acre basis, but on a dairy farm, it makes sense to put it on a per cow basis. So you simply take that income statement and you divide it by the number of cows, each line by the number of cows. All right, we have 80 cows. You take that income statement and the milk sales, total milk sales divided by 80. We're looking at the averages here. My cows are bringing in $3,328 worth of milk per cow. Crop sales are negligible. Cattle sales, $348 per cow. And so my gross income, $3,800 per cow. And then here's my different expenses per cow. Total expenses per cow, $2,500. And my profit is $1,300 per cow. Okay. Now, to make this analysis more useful, I paint some numbers red and green. The green numbers are when my income is more than 20% higher than my competitors, or my expenses are more than 20% lower than my competitors. The red numbers is when my income is more than 20% lower than the competitors, or my expenses are 20% higher than the competitors. Red's good, green's bad. All right, so I'm not too concerned about those two reds up in the income because they're both pretty low. I mean, it's just not a big factor in this farm. $21 and $95. Well, yeah, why am I not getting as much money as the others per other? I might want to go look at those categories and see if there's something I'm missing out on. Okay. But my milk sales are kind of in line with everybody else. My crop sales are kind of my cattle sales are kind of in line with everybody else. Now let's go down and look at the expenses. And let's look at the greens first, because that's positive. Let's look at feed. My cows are taking $436 in feed per cow. This is buying feed, okay? Yes, I have to buy feed. A lot of farms have to buy feed because they don't have enough. And this is an organic farm. I'm probably buying organic hay to get me through the winter. Or if it's a grass farm, I'm not really buying concentrates. It could be minerals, organic minerals that I got to buy. But my costs are $436, and the average of my competitors is $935. That's a strong point in this farm. My feed costs are much lower than my seven competitors, okay? But then I also like to look at seed and fertilizer and some of these other expenses because, I have to grow feed too. I mean, this is feed, I have to grow feed. Well, the other seed, that's even better, okay? And fertilizer, it's kind of in line. I definitely see a strength in my feeding program on this farm. All right, now let's look at some negatives. Let's look at depreciation. 461, and that is a lot higher. What does that mean? This means I got too much new paint out there, too much new machinery, okay? And so I got to take a look at that. It's like, why am I buying machinery? Or, it could be that I'm buying dairy cows, organic dairy cows, but in this case, that's not happening. They're not. Okay, so it is machinery. It could be I put up a building or something that I didn't need. But not only that, not only is it twice, not only much higher than my competitors, there's another big problem here. Repairs and maintenance. If I've got new equipment out there, my repairs and maintenance ought to be lower. Because new equipment doesn't need repairs. I have high depreciation on new equipment, and I also have repairs and maintenance. I got a problem out there somewhere, and I got to figure out what it is. Okay? If I have high depreciation and low repairs, they offset each other. But that's not the case here. Okay? I would look at the other the reds too. Supplies purchased, why is that higher? Hired labor, I'd take a look at that. Interest. I'm going to, rent or, okay. Interest, what's that interest on? Well, it could be on that machinery. It could also be on a farm that I just bought. Okay. Sometimes when I look at the interest, I will also look at the rent or lease. Okay. I am not renting much property from somebody else. So if this interest is on my mortgage, I'm not too concerned about it because my rent or lease is low. I own the land. My point is, you can't just look at a line and say, oh, that's bad or that's good. You have to look at the whole picture, and some of these are closely related. You look at the ones that are closely related because maybe they aren't bad when you look at, there's offsetting expenses that are okay. All right? So this gives us an idea of how efficient we are. Definitely in this farm, we have efficiency in the feeding program. Definitely, we are inefficient in the machinery management of this farm.
So, I have a question.
Any questions?
Translate to horses, because horses, it's not a per animal production value. They all are doing different things.
Horse operations are difficult. And there's different ways of doing the analysis. For example, per animal per day, the cost of animal per day. Okay?
The cost of keeping them per day less of what you charge.
Yes,
Always,
yeah.
You should know what it costs every day, but then if you're training for other people, there should be a little bit of a profit there.
There's all kinds of problems with horse operations. First of all, even if I went out and did an analysis of 10 horse operations, they would all be very different. Even if I got some somewhat similar horse operations, they were going to be very different. Different levels of boarding, different levels of training, different levels, different things that you're doing. They're all going to be very different. So maybe there's a good reason I get a dairy farm and not a horse farm here.
You still need to know the input costs.
Yes.
That's all valuable, but how do you, if you're doing different things with your horses?
But you can still have what it costs per day for each horse.
Even if they're doing different things.
Yeah.
Yes.
I mean, in other words, you got 20 horses in your feed bills.
Yeah, thank you. You're saving me here.
What?
You're helping me out here. Yeah,
But
thank you.
You can figure that out pretty
Yes,
easily.
yeah.
Regardless, you got a feed bill comes every month, and you know how many horses.
Yeah,
you
the
have.
production per horse is what you have to be different, whether it's a breeding stock or training or anything. I'm sorry.
Right.
We're
Yeah.
checking that.
See, my wife had horses. And I went along with it, and I was sure glad when my daughter grew up and bought her own horse farm and took the horses. I got steers out there. Actually, I really like looking out there and seeing the horses. I'd rather look out there and see horses than the steers, especially when those steers break through the gate and I had to go gather. Horses are easy to get back in than steers are.
What breed? What breed of steer?
Interesting you ask.
They got to be black Angus.
One organic dairy farm that I am working with, they breed beef into their cows, into their dairy cows, because they also sell a lot of organic beef, and so they got to have, they got to have some little. A jersey's not going to work, so they put some beef into it. There's a lot of different breeds.
Yeah, I know.
Okay, so I bought some dairy steers, but they're beefier dairy steers than a Jersey or they're not Holsteins.
The Angus are just simple.
Yes, yeah. There's I think there's some. One of these is pretty black, so there's some Angus in there somewhere.
Yeah,
But
that's
I'm getting off track here, you're all tired, and I got a long drive too. So, okay, now I'm not going to go through this, but look at this. Per hundredweight. So we can go back through here and look at things per hundredweight. And let's just look at the feed, 4.71 per hundredweight. And now look at that's even more dramatic compared to 1040 per hundredweight. Why is it more dramatic? Because it takes into account milk production too. So this is going to tell some similar things as the per cow analysis, but sometimes it can be a little bit different because my cows may have a different production level than the average. Okay? So it could give me some additional information. And my point being is there's a lot of different ways to look at businesses. Horse operations, there's lots of different ways of looking at it. So, okay. I'm not going to spend much time with cash flow because it takes some time. And we don't have it tonight. I've spent more time teaching cash flow than any other financial principle. And I've done this around the world. Because cash flow is very useful. I wish I had more time tonight, but how do I go back now? Oh, I know. Okay. Whoops. When you're looking at cash, let me go down here. When you're looking at cash, here's my cash income, sales and revenues. Here's my cash expenses. We've already talked about those. Okay? But I sell a piece of land or I sell a piece of machinery. Okay? Those are capital sales. They're not revenues or cash income. All right? And then I might have some non-business income. Perhaps a member of the family works off the farm. And some of that money makes its way into the farm somehow. Somehow, it often makes its way into the farm. And then we have our cash expenses. We got to go buy another piece of equipment we're going to put up a new building. All right? We have loan payments. And we withdraw money why would we withdraw money from the business? Because that's what we're in business to do. We're trying to make some profit so we can support ourselves. This is the purpose of the business right here. We're going to withdraw some money from the business. All right? And cash flow is all about balancing inflows and outflows. All right? Call it the liquidity reserve. It's a checkbook balance. The bottom line of a cash flow is checkbook balance, bank account. How much money have I got in the bank? All right? Now, oftentimes we have a lot more money coming in than's going out, and the bank account builds up. And oftentimes we have less money coming in than is going out. The bank account becomes depleted. Sometimes it's really depleted. For example, I got to buy a piece of equipment. I don't have the money to buy it. So what do? Get a loan. Okay, so loans are used to balance the cash flow. But we should try to balance this as much as we can without loans, so that we're only taking the loans when we really need it. And sometimes we really need the loan. You're going to go out and buy another farm. Obviously, you're probably going to need a loan to do that. Okay? So, contrast income statement and cash flow. All right. Cash income, cash expenses, depreciation. No depreciation on the cash flow because we don't write out a check for it. Okay? Instead of depreciation, we have capital purchases over here. All right? Depreciation is spreading out that capital purchase over several years. All right? We have capital purchases, but we also have capital sales. All right? These come in pairs. Cash income, cash expenses, capital purchases, capital sales. We have loan receipts. We got to borrow money. We got to pay the money back. Interest is an expense. Interest is an expense, but we borrow money and we got to pay money back. And then money flows into the business from other sources, and we take money out of the business. All right? So we have our ending cash balance. So you can see they match up quite a bit simply because cash income and expenses are a big part of the business. So they match up quite a bit. But there are some of these other things, especially if we have to go out and buy a piece of equipment. We have to look at our cash flow. And oftentimes we will, and then another thing about cash flow is cash flow, we're usually looking at it by period. All right? The year is usually not enough. We want to break down the year into quarters or months. Each month, if we're going to have enough money to pay our bills, or each quarter. You kind of got to decide what you're going to do it for. So here's a projected cash flow. This was 2021, and then they're projecting the cash flow for 2022. And the reason this is so useful is that you cannot project all these numbers for the next year unless you really understand the business. Cash flow makes you understand the business. For example, in this, what's my milk production going to be the coming year? Well, maybe I've figured out some ways to improve my milk production. Okay? Or maybe I have not been a grass farmer and I'm going to go to grass to try and get a little bit higher income. All right? I'm planning out the coming year, and so I have to understand my operation. So this is why I think cash flow is so useful. It makes you a good manager. It makes you think about every aspect of your farm operation. You got to go through every one of those expenses and say, okay, what was the expense last year? What do I think it's going to be this year? And you're going to shoot from the hip and give it your best guess, but makes you think about your expenses for the coming year. It's like, what are they going to be? And so we estimate what those expenses are going to be, and then we put it, what quarter or what month are we going to have that income or expenses? All right? And then what's going to happen is we're going to get down here, and we come down here, and here's going to be the net farm profit for the first quarter. All right. Just a minute here. I never rehearsed this, so I got to remember what I'm doing here. Okay. So we go down here, and then we've got off-farm income that's coming in. All right. It's one of those things that's not revenues or sales. Off-farm income. We got a capital sell. We're going to sell a piece of equipment. And if we add those, here's our cash available. Okay? We got our net farm profit plus off-farm income, capital sale. We're going to have $51,000. We plan on withdrawing $15,000 for the family because that's what we're in business to do. And we're going to make a capital purchase when we're buying a piece of equipment. All right? Scheduled loan principal payments. We've got to make a mortgage payment. The principal, the interest is on line 21. We got to make a principal payment. And if we buy that piece of equipment, we're going to have to take out some debt. And maybe we're going to take out some money on a credit line. And so the bottom line is how much cash flow do we have at the end? And usually, you don't need a lot here, but it needs to be positive. And this line here tells us how much are we going to have to borrow. How did I come up with this $30,000 that I got to borrow for that piece of equipment? How did I come up with $30,000 to borrow on a credit line? Because that's how much I had to figure out where that deficit was going to come from. So this helps me figure out, how am I going to cash flow? Do I have to borrow money? How much am I going to have to borrow? And when can I pay it back? All right. And so then we go through each quarter and we do the same thing. And we find out when we can pay money back. All right. So, I mean, cash flow is kind of complex. I just don't have the time to get into it tonight. But you can kind of see how you need to take a look at your cash flow and balance that income coming in when it's going out. So you're in charge of it. You know, the bills aren't just stacking up. You know what they are. And you know where the money's going to come from. Right? You know when you have to borrow money, how much to borrow, and you know when you can pay it back. And if you have to borrow money, you go to the bank. Say, I need to borrow some money. Well, what's the first thing they're going to ask for? They're going to ask for your balance sheets. They're going to ask for 3 years of tax statements. They're going to ask for 3 Schedule Fs or 3 Schedule Cs. And then, so you give them the balance sheet, you give them the Schedule F, the Schedule Cs, and then on top of that, you say, here's my cash flow. Here's the money. Here's how much money I need each quarter, and here's when I can pay it back. In this case, I need to borrow $30,000 on the credit line in the first quarter, but I can pay it back in the second quarter. And the bank says, oh, fine, you got it. All right. So this helps the bank see what you're going to be doing. It's the plan. It's the plan. And it's always nice to know that, you know, you're going to have money at the end of the month or end of the quarter. Okay. So those are the four pieces of the financial analysis, the 4 pieces of the puzzle of the financial analysis. If you're missing one of them, you don't have a complete picture of the business. And usually, we usually miss one of those pieces. We don't, you know, there's something that we don't do. But if you've got a business, I encourage you to do all 4 pieces of this puzzle. Personal finances, you know, the efficiency doesn't make a whole lot of sense. Okay? And even for some farms, if you only have one product, it is the income statement. If you only have one product, it is the income statement. But this will give you a good idea of what your finances are. I encourage all of you to track your personal finances, set goals for your wealth, set goals for, do your budgets. How much money is coming in? How much money is going out? You know, do you want to do things with your life? You know, what can you afford to do? What do you want to do? Where's that money going to come from? You want to do things with your children. You know, where's the money going to come from? Also teaching this to children, teaching it to grandchildren, making sure that your business is financially healthy. I encourage you to, I mean, you don't go into business to do this. Okay, you know, okay, I think I'm going to be a horse farmer, I'm going to be a dairy farmer because I like doing finances. No. You treat this as a chore. You know, you automatically go out and feed the livestock every day. You automatically change the oil on the tractor. I encourage you to automatically do your finances once a month. You know, maybe choose a day. Okay, I'm going to do it the last Friday of every month, and I'm going to take a couple of hours. And if something comes up that day, I'm going to do it the Monday, but I'm going to do it every month. Instead of wait till the end of the year and then try to get everything together so that I can put it into TurboTax and do my taxes. No, that's not you have to do that. But if you keep good track of your business, TurboTax will automatically do itself because you will have the good records. Encourage you to, you know, get QuickBooks, get Quicken or other accounting software. Set it up right, and it helps you do a lot of this so that it makes it much easier. Any questions? Yes?
I don't have a term, but I know there is one in the accounting industry. Let's say you know that I'm going to use horses as an example because I know it.
The what?
I know horses.
Yes.
So let's say you know that you're going to have a large vet bill
Yes.
in January or March for vaccination and just yearly things. Can you put aside money in one of these statements for that bill as planning for that and then have it listed?
Mm-hmm.
And where would that go?
First of all, at the beginning of the year, you might actually have some money in the bank. You might have $10,000 at the beginning, at the money. You're doing the cash flow for the coming year. And you say, you know, on January 1st, I'm going to have $10,000 in the bank. That's not unusual. And you can say, okay, I want to make sure I've got the best use of that. So what are my income and expenses in January? Okay, but I also want to look forward to February. And I got this big vet bill coming up. I got this big vet bill that I know it's going to come up in February, or it's going to come up in January. All right, well, I could use that $10,000 towards that vet bill, or I could say to myself, you know, I want to keep a padding here, so I actually want to take out a short-term line of credit to pay that off, and I'm going to pay it over time, so that I'm not putting all my money into that one thing, and then I'm going to be squeezed somewhere else. So you're basically planning it. Or you can also say to yourself, okay, I'm going to call up the vet and say, you know, I'm going to have this big vet bill. Can I spread it over 3 months? And oftentimes they're going to say, yes, you can spread it over 3 months. That's fine. Sometimes they might charge a little bit of interest or something. But the bottom line is you're taking a look at that. You're taking a look at that cash flow, and you're saying, and there's the vet bill right there, $1,000 here. That's not bad. $8,000. Where is it going to come from? And putting down all these expenses and income with the possibility of borrowing money, it makes it a lot easier to figure out where it's going to come from. Did I answer your question? No.
Not exactly. I was thinking more of putting away money throughout the year, knowing that next year you're going to have this big expense. Is there a way to track the money that you're saving for that expense?
So that would really come down to budgeting. So what you're doing is you're saying, okay, I have looked at my cash flow, just like Dale's talking about, and you're saying, I know that in the second quarter I'm going to have Coggins, and I'm going to have all of my, you know, my health certificates are going to come due, and all of my stuff, you know, for the vet, like you said. So what you would do is you would say, okay, here's my cash flow, and then you would take a look at that budgeting. So you know that you're going to need that $10,000 in March, so in that first quarter. So you have that budget set. What you do with those funds, or start to build those funds up, just takes place in your checking account, your savings account, putting it to the side. So then when you're doing something like you're making a balance statement, because it's that specific period in time, you can take a look at your checking account, your savings account, and see, oh, there's that $10,000 I put into the savings account. I know that I put that in there specifically for the vet bill that's going to happen in March. So it's not one specific place that you're going to put that number. It's kind of all of these statements that Dale and Sherry and I were talking about earlier kind of coming together. So like Dale was saying, kind of take a look at your income statement first, because that's your income and your expenses, and then translate that into your cash flow statement and kind of work from there to figure out, okay, where's my money coming from? Where's it going? What do I need to be able to pay from there?
And look at this example here. This is at the end of 2021, and there's only $1,400 in the bank. There's only $1,400 in the bank, and we got a lot of expenses coming up. Total expenses, $52,000. Okay? And we're going to buy a piece of equipment. So it's not just a vet bill. We got a piece of equipment we got to buy. So how do we do it? Well, we went through this whole thing, and we looked at each line to make sure maybe I could have cut that repairs down 15,000, maybe postpone some of these repairs to the next quarter or something. But this is what I came up with, and I decided I'm going to borrow that money for that piece of equipment, and I'm going to take out a line of credit. And then, through working through this process, I found out I can pay off the line of credit the next month. And then I got $10,000 left over. Now, this is getting to what you're talking about. What am I going to do with that $10,000? Well, let's look at the next quarter. And, we scrutinize each category, and we figure out what we're going to bring in and what we're going to expend. And the next quarter looks even better. We're going to have $17,000 at the end of the next quarter. So we take a look at that, and what do we do? So it's kind of a big picture. You're looking at all, that's why I like the cash flow, because we're able to look at everything. We're able to move money around, perhaps postpone some of these expenses till some of these expenses I might be able to postpone till later. If I got that big vet bill coming, can I postpone something else? And if you got it all down on paper, you'll be able to see that. Thank you. Any other questions?